Well, hey there, everyone. Happy Tuesday, August 5th, and welcome to Chart This with Dave Keller. It is a beautiful day. Sunny, not too warm, nice and cool here in Redmond, Washington. Hope you guys are doing well wherever you're at and hanging in there. The market's rolling over a bit today. I mean, big sell-off right out of the open for sure, and a sell-off in the last half hour of trading as well. So sort of those most important periods, sort of the initial reaction after the open, which is it's called the opening range, like what you do in that first 30 minutes. And then what happens soon afterwards is usually very telling. Today is one of those where the first 15 minutes were quite strong. And then we rolled over and eventually made the low for the day just around 10:45 a.m. Eastern time. Short-term movements aside, generally, this is a weaker day in terms of breadth conditions, which were really more neutral than anything, and maybe slightly positive in some groups. The sector breadth pretty negative, with technology almost at the bottom of the list, along with utilities and communication services. Only 4 of the S&P sectors finished in the green. Some news after the close with AMD gapping lower, it appears, with their post-close earnings report. So a lot of charts to talk about. We're going to talk about the spike in bonds this week. Bonds starting to rally. They really started, end of last week, but this week you're continuing to see bonds rally as equities are starting to give back a little bit of their previous gains off the lows. Gold still in great shape with the GDX making new all-time highs today. With that in mind, let's get to the charts. I'm realizing I had this maybe half set up, I think, when we started here. There we go. Let's look at the charts together. So we're going to look at the charts. We will look at the heat map and talk about how conditions have evolved today. And then we'll finish off looking at a series of individual macro charts and then some individual stock charts. We'll wrap with a question or two from all of you. As a reminder, we are live streaming on Facebook, LinkedIn, YouTube, and X. Welcome your questions along the way for sure. If you're watching the live stream, drop a question in the comments section of any of those platforms as you watch. I can see them all here live in the home studio, and we'll take a question or two before the end of the episode. So average is moving lower today. You can see the S&P down about 0.5%, closed just slightly below 6,300. You can see the NASDAQ composite down about 0.2%. Small caps actually positive today. The small cap 600 index up about 0.6%. The VIX moving higher, about a third of a VIX point, so still below 18, still obviously below 20, and that is overall a market in a low volatility environment. But we obviously saw the signs of initial sell-off at the end of last week. We're seeing continued deterioration here through the course of this week. Palantir still making new all-time highs. I was talking with Keith Fitzgerald, who a fellow Pacific Northwesterner. We did a brief podcast with the team at the Money Show in preparation for the Orlando Money Show coming up in October, where I will be attending, and I hope I will see some of you live in person at my presentation there. But we're talking about market conditions. He's been all bulled up about Palantir for a long time, and he's been proven very correct with the stock continuing to go higher. I always think, in this sort of environment, with it like AMD gapping lower, with SMCI, as someone mentioned, dropping pretty good, stocks do very, very well until they don't. And that's why I would say the reality is with stocks and consistent uptrends, right? I mean, as much as we want to pinpoint the top, I think as a trend follower, you want to follow the trend. And I always think of it as long as the chart, is telling you it deserves a place in your portfolio. And then when it tells you it doesn't, that's when you need to start changing. I'm seeing a little glitch here in the platform I'm using, and I hope it's not a chronic glitch, but I have to keep adding the screen back. So apologize if you get a little zoom in there. That's unintended, but I'll keep a watchful eye on my left out of the corner of my eye and see if that happens again. All right, that's it for the major averages. We'll look at the chart of the S&P, talk about some key levels here. No significant change from the levels we talked about yesterday, but we'll see where we're at relative to some of those short-term expectations. Bonds moving higher again today. We're seeing the TLT start to bounce higher. We've looked at the chart of the 10-year yield and other interest rates a number of times, but today we'll look at bond prices using the TLT. The dollar was basically flat for the year here. Looking at the commodity space, kind of mixed, to be honest with you. The energy side, particularly crude oil, weaker. Energy did not have a particularly great day today. Copper prices lower. Copper prices often a good indicator of economic growth or expectations for economic growth. Because if we're building a lot of buildings and cities and infrastructure and stuff, you need a lot of copper for that. And so copper prices going down, at least for a longer period of time, would imply less optimism or less demand for an industrial metal. Precious metals are doing okay. Gold ended up being flat for the day. I mentioned gold stocks up a lot more. So the GLD was flat. The GDX, which is a gold miner ETF, up a lot more than that. Silver up about 1.1%, continuing to outperform. By the way, latest episode of the Market Misbehavior podcast. I sat down with John and Jack Kosar at the end of last week. That episode is now live on our YouTube channel. We're now on all the podcasting platforms like Apple Podcasts, Spotify, and others. So wherever you get your podcasts, please check out Market Misbehavior with Dave Keller. Do me a favor and hit a like or a thumbs up or whatever you can do. That seems to help a great deal. But the best thing you can do is listen at your leisure. And I hope you enjoy some of those great conversations I've been able to have. The reason why I mentioned it here is because I spoke with Jeff Huge of Alpha Insights and his retail product called Huge Insights. And we talked about a relatively bearish view for stocks, but a pretty optimistic view about precious metals. He was pretty early on in the silver trade, mentioned before this year, silver was going to be the trade of 2025. So far, it's done remarkably well and has outperformed the NASDAQ year to date, up again today. We'll have that episode for you, hopefully tomorrow morning. All right, looking at cryptocurrencies, all in the red today. You can see Bitcoin rallying a bit here through the last couple hours, currently trading just below 114,000. It did get up above 115,000 going into in today's 24-hour period. But all 10 of the top coins here starting to rotate lower. Someone mentioned the interview with Adrian Zadunchik, founder of the Burb Nest. He was an early crypto adopter, a crypto pioneer, I would say, and has built out a pretty good community of crypto and Web 3.0 sort of content. I interviewed him, boy, it's probably been a month ago now on the Market Misbehavior podcast. He talked about unwinding a pretty decent position in Bitcoin and address some of the challenges, seasonality being a part of it, the trend that they've experienced, how there's a normal pullback that often is fairly significant. You should check out that interview. But since my interview with him, Bitcoin has definitely not been breaking out in any significant way, and that has definitely been top of mind for me. Glad someone mentioned that one and enjoyed that interview. All right, looking at the 11 S&P sectors, materials number one, up 0.7%. Gold miners and other mining stocks continue to thrive in this environment. REITs number two, up 1/3%. Energy, I actually apologize. I thought I remembered it at the bottom of the list. It's actually third, tied with consumer discretionary, slightly above zero level. On the downside, utilities, which has been one of the better relative performers here in the last couple of weeks, giving back some of those previous gains, down about 1.1%. Technology and communication services both down about 0.8%. Those are two big sectors in the S&P, certainly two large sectors in the NASDAQ 100, showing a bit of weakness there. The breadth in small caps, pretty good, right? 61% up, 37% down. A little more neutral in the rest of the area. Near a composite index, actually not too bad, 56% up, 40% down. We can see with the S&P 500, though, decliners outnumbering advancers, 54 to 45%. So breadth conditions, I think, are pretty important here. I mean, we have a market where, for every Palantir, I feel like there's a number of other stocks that look a lot weaker, right? Palantir just kind of continue to go up and to the right. Others have been struggling in some smaller or large ways. There's that glitch again. Sorry about that. And so I would say this breadth is important to watch in this particular environment to see if we get further weakness. And what can happen a lot in a scenario like this, breadth indicators start to rotate lower, even as the index still looks kind of strong. And it's because the meta kind of big mega cap growth names look good enough and are in still enough of an uptrend that they are able to keep the S&P and the NASDAQ fairly elevated because of their weight in the index. And even if everything else starts to struggle, the indexes will still look okay. That's why breadth in this scenario is actually pretty helpful to watch, because any big drop in breadth would tell you that there are fewer and fewer stocks that are actually participating in the uptrend. That can often be kind of a negative sign. pretty common at market tops, actually. By the way, one final comment. I didn't grab a bunch of healthcare stocks, but I'm noting Pfizer and UNH, two of the top performing names in the S&P. I would say UNH in particular has quite a bit to prove. We're coming off of a new monthly low just on Friday's session. However, nice counter trend bounce to the upside, I'm noticing. All right, looking at the mega cap leadership stocks, what we call the Magnificent Seven names, we can see Amazon, which has actually been struggling after gapping lower on earnings last Thursday. You can see Amazon up about 1%. The rest of the Mag 7 names were down. Netflix continuing to deteriorate, down another 2%. Meta, which had a nice bounce yesterday. This is after Friday's sell-off from the earnings gap. Yesterday, a nice rally. Today, a bearish move. You actually call that a bearish harami pattern if you know your candlesticks. So where you have a big up day and a down day, and the down day, the range is smaller than the up day. It's called a bearish harami pattern. It tells you the next 1 to 3 bars most likely lower. Broadcom with the same bearish harami pattern, probably call Microsoft a bearish engulfing pattern. So all of those names with bearish candle patterns here today. All right, let us look at the market carpet. As a reminder, I can see questions coming in from the various live stream platforms. Any questions that come up in the course of the discussion with the heat map and with the charts, pop them in the comments section. I can take a look as we go. And anything we don't get to, we will put it in the all mailbag episode coming up this Friday. Heads up, I am planning a pretty decent break here with my family later in the month of August. Most likely, we'll take a break from the show for a little bit. I also need to get my daughter to boarding school in Michigan. As I may have mentioned, she's going to a music high school for her senior year. Boy, the family's struggling with that emotionally, but life goes on. So I've got some family things to work through, but we'll let you know certainly with as much warning as possible if we do take a break from the broadcast to do some of those things. And we'll definitely be back in September for sure. All right, looking at the heat map here, right? Palantir sticks out with a positive update, up another 8%, new all-time high today. Intel, which has been one of the weaker semiconductor stocks, sort of a negative outlier from the semiconductor space, bouncing off of some lows. I mean, if I'm a swing trader, I'm probably looking at Intel below $20 and thinking this looks pretty interesting, right? I mean, if you look here, I mean, if you bought Intel when it's down in like that $18, $19 range, I mean, not something you would be disappointed with, right? In the last 12 months, right? Starting last August. If I buy every time Intel hits 19, hopefully I'm unwinding that position after a good rally, but that seems to be the floor, right? And the weekly chart probably makes that even more obvious. This is when weekly charts are so helpful because you can see a very clear area of support. So, you know, I don't do a lot of swing trading as my primary investment, so I'm more of a position trader. But if I was, I'm looking at Intel as a potential bounce off of the lows. Intel's actually one of the more defensive semiconductor stocks, if that makes sense, tends to underperform in a bull phase, right? So when semiconductors are all working, Intel's usually more of a laggard. But when semiconductors struggle, Intel tends to hold its ground a little better. You know, something to look for. And you can see that here, right, where he rallied in Q1 and then basically came right back to the lows. So it hasn't gained a lot since the April market low, but it's already right back to that point. So while other semiconductors have had these runs and look like they're really due for a pullback, Intel's already had its pullback. It's already been sideways. It's already at the lows. Boy, I'm writing that one down. Maybe I do make a swing trade on that one. But for now, not something I try to spend too much time on. I'm also, you know, again, it's the challenge for these kind of movements with charts like CrowdStrike is they don't go up forever. And I think that is what is fresh in my mind with all of these growth stocks that have had incredible runs. You can argue here why CrowdStrike should keep going higher to $607, $700, and even $1,000, and whatever other obscure upside target you want to come up with. But one thing I've learned is stocks don't just go straight up, right? At some point, they will rotate lower and give back some of those gains. And that's actually a very healthy thing to see within a bull market phase. But CrowdStrike, right? I mean, it's starting to show weakness, right? We failed to hold the 21-day EMA. That was earlier in July. We then failed to hold the 50-day moving average. We're breaking below there. I mean, that's the kind of chart I probably would be rotating out of, or at least taking a partial position off, just in case this is the beginning of a much deeper corrective move. We get down to the 200-day moving average. That's where I might reassess and see what sort of signs of accumulation we might be observing. But for now, CrowdStrike has gone from clearly one of the stronger charts you could come up with in May and June to one that is showing quite a bit of weakness there. What else on the heat map here? I mean, very mixed day, but I'm noticing some strength in healthcare. Pfizer is one we're going to grab, a potential bull flag pattern I want to tell you about. CVS is interesting, bouncing off of a support around $60. Humana, similar to Intel, kind of bouncing off of a fairly low level, bouncing off of around 224 and pushing to the upside. Also noting industrials, right? I mean, the industrial sector, besides technology, it's hard to find a sector that's done better on a relative basis than industrials. Probably utilities would be the third on that list in my mind. But industrials overall have had quite a bit of strength. You're seeing Jacobs break out. We're seeing LDOS break to new swing highs. There are charts like Builder out there. When you compare again, this is what is top of mind as I'm looking at CrowdStrike kind of names, right? CrowdStrike had an incredible run in May, June, all of a sudden July, and now August, we're starting to roll over. Kind of the total opposite for something like Builder's First Source, right? This is in the building materials group. Downtrend for the first half of the year, making a new 52-week low in June as we retest the May lows. Then all of a sudden we start making higher highs and higher lows. I mean, it's still below the 200-day moving average, but that's definitely a sign of a rotation, right? From a distribution phase to an accumulation phase. And I wonder, given the seasonality, given the traditional weaker market action in August and September, given the run that a lot of the leading growth names have had dominating returns in 2025, besides things like gold and others that have done much better. But in the equity space, technology and other growth names have done quite well. I wonder if it makes sense to diversify in some of these laggards that have been struggling that are now starting to improve, right? If you're concerned about positions you have rolling over and you want to take some off the table, just a protective measure, the question is, what do you do with that? And I'm finding charts that have been underperforming that are starting to improve, and that's certainly top of mind for me as well. By the way, I did release a video. I don't think it's on posted to stock charts yet because my producer that posts things on stock charts was on vacation yesterday, was out. But I did a top 10 charts to watch for August 2025. It went up an hour ago, so you can find that on the Stock Charts TV YouTube channel. Check that one out. I don't think BLDR was one of them, but I picked 10 different charts to talk through some specific levels, entry and exit points, and trend analysis to highlight for all of you. All right, I think that's it for the heat map. Let's get to the charts here. Thank you for all the questions. I see them coming in. We've got a couple we can answer. If you have others, please pop them in here. It's never too late, and we'll grab a couple questions before the end of the episode. Everything else we'll get in the mailbag and hopefully answer your question on Friday. All right, daily chart of the S&P 500, 6,200 is kind of the level for me. Today, this pattern, all right, quick quiz. What is this chart pattern? What is this candle pattern, I mean? S&P 500, and I'll bring up the chart and mention it. So here's the story, right? You have an up day, and then you have a down day. A bearish engulfing pattern would be we go all the way below day one's open. So that's when you have a big up day and a big down day, where day two goes all the way below day one's open. This one, we don't get below the open, but we get at least 50% of the way through day one, which it looks like we just barely did today. So that's a different candle pattern. Does anyone know what that two candle pattern is? Titus Ryder, points, my friend. Congratulations. First to respond correctly, the dark cloud cover pattern. I love that name, right? Dark cloud cover is just such a great visual. Some of the candle patterns are kind of ridiculous, like a gravestone doji. Like it's a little weird, but dark cloud covers, just this beautiful, ominous kind of weather pattern. I love that. I love that candle pattern. So jump off of the Friday sell-off. Yesterday looks pretty good. Today, down below the open would be a bearish engulfing pattern, but a higher open and closing at least 50% of the way through, which are like just barely over. Dark cloud cover pattern suggests the next 1 to 3 bars most likely lower. So that's where we're at today. Short-term trend looking a little weaker to me, right? We're right at the 21-day EMA again today. We traded on an intraday basis right exactly to it. So I think we're in a potentially vulnerable position. For me, breaking below 6,200, and I think a very easy extension to that, breaking below the 50-day moving average, makes this look more like a significant pullback where we have to identify some downside targets. So I think of this kind of market as an if-then statement. Anything above 6,200, I'm thinking of as just kind of noise. And what I mean by that is it's not that those moves aren't meaningful and interesting. It just means that unless we break 6,200, it's just not getting that bad. If we would break 6,200, I think that's when we would start to think about, all right, what are some downside levels that we could test? And then the question that you have to ask yourself is, am I comfortable, holding things as the S&P goes down to 5,900 and tests the 200-day moving average, or goes down to 5,450 and makes a 61.8% retracement of the 2025 rally? And if the answer is yes, I can handle that, then don't sell anything, right? Just hold and go off to a beach somewhere and don't worry so much about it. Given the seasonal weakness that I think is most likely going to be the story here in August and September, I could be very wrong on that, but it has usually been a pretty decent bet to consider August and September to be relatively weak, to assume that in a post-election year, those months are going to be challenging. I'm expecting that until the charts tell me otherwise. But giving some of the vulnerabilities that we're seeing in breadth and momentum, given this initial sell-off that feels like the beginning of something more, I think August and September probably end up giving us a lower entry point. Even if you are super bullish, I think there could be a better time, most likely, to identify some support levels. So then the question is just how much pain are you comfortable with? And some people have a long enough time frame. They don't care about this move because they're betting on that huge up move that goes, way beyond there. But if you're more of like a short-term investor, right? If you're more looking out a month or so, I don't think this is the time you probably want to be, be getting into things. This is more of the time when I would probably be betting on further downside and protecting myself, because I'm expecting some sort of lower opportunity to layer back in down the road. That's kind of the base case. What I've learned as a technical analyst over many market cycles, you have a base case. You have kind of that thing in your mind that you think is most likely based on your analysis of market history and all the evidence, that's what you're expecting. But be very ready for the market to do something totally different. And my career has been filled with the market surprising me to the upside and the downside, and I've learned something every time. I'll learn again this time if that's the case. Breadth measures have certainly gotten less awesome, but they're not really negative yet, right? The McClellan oscillator has been negative for about a month. That's true. At the bottom panel here, you can see the percent of stocks above their 50-day moving average still holding the 50% level. So even that basic assessment of internal weakness still favoring risk on here. But I would say it's very, very close. Friday, we sold off right to that 50% level. For now, this week, we're kind of holding above there. That breaks below 50%. That means most of the S&P would be below their 50-day moving average. If that happens, I think that would confirm a pullback scenario here in the month of August. Longer-term correction almost always, if not always, sees less than half of stocks above their 200-day moving average. Things tend to fail to hold those levels. That's what I'd be watching for there. So if stocks are looking at a little bit vulnerable, what kind of things are working? Bonds are actually starting to work in a pretty big way. If you look mid-July to now early August, the TLT is up significantly from around 84 to now 88. So a 5% rally here in the last 2 weeks or so. We can see that the momentum has shifted. Note how we are now back above the 200-day moving average and continuing higher. The RSI is pushing above 60, which we've shaded in green, that bullish range, right? When the whole range of the RSI drifts higher, that tells us we're in a primary uptrend, right? We're seeing stronger upside momentum that is outweighing any sort of selling that happens along the way. So the whole range moves higher. In red, we're highlighting when the RSI is more in a bearish phase, because when we sell off, when we have a distribution phase, the whole range of the momentum goes lower. We're actually back, I would argue, here in the last couple of weeks from a bearish range that we were in from April through July to now more of a bullish range. And I think the breakout this week on stronger momentum kind of validates that bullish thesis for bonds. There's no reason why stocks and bonds can't go up. That actually has happened plenty of times in market history. Even on this chart, you'll find times like January and February, right? Stocks and bonds both went higher until equities eventually hit a peak. But I think for what it's worth, bonds have not been a particularly great place to be in 2025. But that seems to be changing here with improving momentum and more of a stronger uptrend phase as rates, of course, are starting to drop here. Gold miners breaking out here. Here's the GDX, which is a gold miner ETF, making a new all-time high today. We're up about 3% today after a similar gain yesterday. We've bounced off the 50-day moving average. The moving averages are in the proper order. The momentum is improving. I think this is the kind of chart I like a lot, right? Charts going up and to the right with pullbacks that resolve to the upside. Gold has been a place I've been for a while. Continue to have a position in GLD and IAU. I don't own GDX that I remember at the moment in a portfolio that I own. I might, but I don't think so. That's an uninformed disclosure, but I'm pretty sure I don't. But I definitely own making a gold bet in other places. But I think the strength in gold stocks pretty strong. Newmont Mining, obviously one of the better S&P names here in recent weeks, starting to pop out and break out itself. Meta for now, holding that breakout level. I have an alert set for Meta at 740. I would encourage you to think about that as well. In bull markets, stocks like Meta with great earnings break out and then continue higher. And people are so excited about the potential to gain that they layer in and are willing to pay more and more. That's what causes an uptrend to continue. In the case of Meta, though, it's stalling out a little bit here. And after that gap higher that we had on earnings, they reported earnings on Wednesday, gapped up on Thursday. Friday, we pulled back. Yesterday, Monday was up. Today, rotating lower. You'd call that a bearish Harami pattern, right? With yesterday and today. So a lot of bearish kind of 2-bar reversal patterns from Monday's rally and now Tuesday's pullback suggests, maybe a weaker for Meta through the course of this week. 740 is the level that I'm watching. If a chart like this can't hold that breakout level, that's not a good sign, because that tells you it's less about Meta's ability to grow earnings and create new glasses that you want to wear, and with all sorts of information on them, augmented reality style, as Mark Zuckerberg has mentioned many times. If stock breaks 740, that means it's less about Meta and it's more about just people's appetite for risk here. Risk appetite, I think, matters a lot in this environment, particularly after the run that we've had. Now, what I say, because I see the seasonal weakness and I see deterioration in breadth in some places, do I think you sell a stock like Palantir just because I'm worried about the macro environment? 100 out of 100 times, no. I sign off every episode of the show with it's always a good time to own good charts. I think that's true today as it was yesterday, and it will be tomorrow, which means charts like Palantir in primary uptrends, making higher highs and higher lows. That's the kind of portfolio I would want in any environment. Doesn't really matter what the macro conditions are. But it does tell me if I have been riding this stock higher and I'm continuing to log those paper gains, what you don't want to do is hold on to Palantir all the way down if something horrible would happen. This is why we use trend following techniques. This is why we watch things like the 21-day EMA as maybe an initial stop. Things like the chandelier exit, which we've talked about before, are all money management tools. They're not really, I don't think of them as much technical indicators. They're not a predictive tool, right? It's not a crystal ball telling you what's going to happen tomorrow. It's just recognizing if something bad happens today and limiting your downside exposure, right? And the way you do that is follow the trend higher and have some sort of stop in place. That's how I would approach something like Palantir. Innocent until proven guilty. Today, we're making another new all-time high. That's pretty good. In terms of things that are not as good, Apple has failed to get above 215 a number of times, regardless of what you think about Apple's phones and computers and other products. And our whole family has so many Apple products. I haven't done a count. At some point, I'm going to do a count, but between Apple TVs, of which we have 2 in our house, laptops, which we all have, iPhones, which most of us have, except for the little AirPods, all those. I mean, it's got to be 30 devices that we probably have in here, which is obscene, but it's probably true. That's probably too much. Maybe 20, maybe 15. I don't know, but it's a lot. It's a non-zero number. But just because you like the products doesn't mean that Apple, the stock, is good. I was told a good company does not necessarily mean a good stock, right? We have to separate the company, the story, the narrative, the innovation, the dependency on their products versus the stock, which is all about expectations about how that first bucket is going to evolve in the future. And so the challenge is right now, the chart of Apple from late April to where we're at today has been a really underwhelming chart. And the way you can validate that from a technical perspective is this series at the bottom, right? From the end of last year to today, Apple has been underperforming the S&P 500, and it underperformed going into the April low. It's underperformed off of the April low. It's had random bits like the initial rally off of the April low where it outperformed, but after that, you're much better off not owning Apple and just owning the S&P in 2025. And I think that tells you about Apple's position as a quote unquote leader, right? I mean, it hasn't been from a technical perspective. I would say the stock breaking above 215, even better, breaking above the 200-day moving average, then we'll have another conversation, and we can make the argument as to why Apple may be deserving of some sort of leadership award. But I'm not throwing a gold star at Apple with how it's performed in terms of, basically sideways price action. This is a stock that is in a range-bound environment, rotating around about $205 a share. Weaker momentum, weaker relative strength. That's the kind of chart I don't particularly enjoy owning. Now, AMD popped on my radar. Funny story, by the way. I actually brought up Archer Daniels Midland, which we'll get to next because it made a new 3-month high. I fat finger typed AMD and I brought up the chart and I was like, AMD is a great one of those charts. I mean, what a beautiful rotation from distribution to accumulation. I think if you're, at the end of the year, if you want to go back and grade yourself about how you traded this year, if you miss this breakout in AMD, that is an area I would focus in on, because think about what signals you could have seen that changed from a distribution phase where AMD is the type of stock you probably want to avoid because it's going down and it's underperforming, to the complete opposite: stronger momentum, stronger trend, inflection in the moving averages, improving relative strength. That's a chart that started to look very good. And I think to this day, still looks pretty good on an absolute basis as we continue to trade higher. The question is, what do we do next? And I would say you switch into trend following mode, and which hopefully you're in, and then you look for signs of a deterioration. Now, they're an earnings name this week. They just reported today. It's down in the aftermarket, just under 4%, currently trading around 168. We'll put us, the low from Friday. I mean, that's not too much of a drop so far. We'll see what happens in the days to come. Chart like this, even through earnings, watch the 21-day EMA. If that holds, I'm not too worried about it. If that would not hold, then we revisit, right? I think thinking of things in that sort of way, big fan. ADM, you can see this is the stock that I originally meant to bring up because it was breaking to a new 3-month high. One of the scans I run every week, stocks making new 3-month highs, stocks making new 3-month lows. I've done that for a long time. I've always appreciated the names that surface. You'll find names like Palantir that have had incredible runs for quite some time, but you also find names like ADM that have consolidated a bit and are just starting to break out here. Had a really good run off the April lows. And then has been sideways, right? We kind of stalled out around $56 a share here for the last month. Today, we're actually closing above that previous resistance. And I would say that could be a sign of the next move higher for, a consumer staples name. That's a food product name in a fairly defensive sector. Speaking of underwhelming charts that are starting to look a little more interesting, Pfizer's another one of these. Call this a bull flag pattern, where you have a big run off of the April low. Lower highs, lower lows, fairly parallel pattern. The buy signal using that pattern, using best the traditional convention, would be you break above the upper boundary. That is a valid breakout of the bull flag pattern. The way you measure this using the Edwards and McGee classic chart pattern methodology, you take the height of the flagpole, which is basically this move, and then you project it from the breakout. So that basically puts an upside objective around $30 or so. I probably have to measure it. I'm doing the, not even using a ruler. I'm just eyeballing it, but probably in the $29 to $30 range would be the minimum upside objective, given that break higher. If I would take a shot on this name, which I have not, I would use the 200-day as an initial stop, because that break above the 200-day I think was pretty meaningful, and break back below that would be a bit of a concern. All right, great questions in here, a bunch of them, and I appreciate Bird Calls. Love your handle. Thanks for watching on YouTube. I don't believe I've taken a question from you before. Today's the day. Knowing when to sell a stock as stock is going up seems much harder than knowing when to buy. What principles do you recommend, and how important is volume in understanding when a stock's move is exhausted? That's an awesome question. I appreciate that very much, and maybe ADM is a good place to sort of answer that. Um, yeah, I think it when a stock has had a run, again, I think there are a couple different things to think about, right? Your entry point, we can buy too early, we can buy too late. Those are the things we probably don't want to do. We want to Goldilocks style buy at that perfect moment, which we're never perfect, but ideally close to that kind of perfect entry point. And then selling, we can sell too early, which hurts because you sell when something's up 25% and then you sit on the sidelines when it goes up another 250%. Has that ever happened to you? I don't have your camera on. I don't know if you're raising your hand. I'm sure it is, because it's happened to all of us, right? There's nothing worse than selling a stock that's had a really good gain. You feel awesome until you just watch as it keeps going higher, and then you're out. So one of the things I learned is selling too early hurts a ton, and it hurts your portfolio and definitely hurts your mental well-being to leave some of those gains on the table. So that's one of the reasons why I became a diehard trend follower, because I worked with enough portfolio managers that showed me the evidence of how momentum has worked so well, right? And certainly as a position trader, buying strength and riding that to further strength has gone very, very well. So to your question, it's like, how do you sell when a stock is going up? I'm not a huge fan of selling when a stock is going up. The time that I would sell when a stock is going up, go back to like a Palantir example. The problem if you bought Palantir like back here and you made a big bet on it, and now it's up from 20 to 173 on an adjusted basis, is that stock is probably way too big of a weight in your portfolio, right? And so I would say the reason why you probably want to start selling stocks that have had ridiculous gains is just because of the bet, right? Think about, you buy 5 stocks in your portfolio, so each one is 20%. 4 of those stocks are kind of flat, and the last one is Palantir for the last 12 months. So Palantir's gone up a ton, and those other stocks are still kind of the same weight. So what happens is your portfolio is basically becoming a Palantir portfolio, and all of a sudden your entire portfolio is going to be driven by this one stock. And while that's great when it's going up, which is why people don't want to sell it, the problem is if it becomes too big, the pain when it goes down is magnified. It's almost like you're taking a leverage bet as it goes higher and higher. So the way that you get away from that is you manage positions on the way up. And what that means is you sort of bring your bet down a little bit, right? If the stock goes from 2% of your portfolio to 10%, you start trimming that position just to bring it back. I mean, still have a position, but make it less of an overweight. And then you're able to reallocate that capital to other places. So that it's more of a money management exercise and more of a rebalancing task that I think is a good reason to sell on the way up. But as a trend follower, I'm a big fan of following stocks as they go higher and using trend following techniques. So in a valid uptrend, this is why I often talk about like a 21-day exponential moving average, because that can also often be a really good signal just to help you remain in a stock as long as that trend continues. And if you start to see some initial weakness, maybe at least you start to take a little bit off as a way of minimizing the fact that you're going to give it all back. What you don't want to do is hold on to a stock as it goes back down and gives back all those previous gains. You asked about volume as well. Volume is not a huge part of my process. However, I would say that I do use volume-based indicators. Chaikin money flow is one that I found very, very helpful. And I would say stocks that are going higher that start to see volume divergences, I get a little bit concerned. My name is Chuck. Thanks, as always, for watching on YouTube, my friend. You asked, when showing the upside flagpole, are you going by percentage in height? Yeah, so the traditional, if you go like the Edwards and McGee book, and again, I often mention that, if you've not picked that up, you should. I mean, it's kind of they call it the Bible of technical analysis. It was written in the mid 20th century by Edwards and McGee, who are 2 money managers and market practitioners, letter writers back in the mid 20th century. Actually, one of my former analysts, true story at Fidelity, is named Susan Berger. She's now retired, but she her first job in the industry was changing the ticker tape for John McGee, co-author of the Edwards and McGee book. He had a desk that had a glass top, and it was a custom designed desk. And then he had a ticker tape machine off to the right, and it would, or to the left, and it would feed the ticker tape underneath his the glass top, so he could watch the market go by. Talk about an awesome, antiquated market history story. I love that story. The Edwards and McGee book is on my recommended reading list. You can find that at marketmisbehavior.com in this section on technical analysis tools and techniques. You really should read that. A lot of the stuff we talk about with price patterns, things like objectives and measurements, and thinking about the shapes of patterns and how to define them are still based on some of the original work of Edwards and McGee, Robert Edwards and John McGee in the mid 20th century. It's gone through a number of revisions since then, but their original charts, I think, still very much hold up to what we're talking about here. You were talking about the flag pattern, though, and I would say with the flag pattern, what do you do? So so there's two different schools on this, by the way. Edwards and McGee were using a lot of arithmetic charts in their book, if I remember right. And so I think a lot of people just basically do the math. So you can take the difference from the low to the pattern and then add that to the breakout. And what you're basically doing is taking this move and then adding it to the breakout level. So what I usually do is draw a trend line. And on stock charts, I do it on the ACP platform. I don't have time to bring that up, but it's better because you can customize a little more dynamic. But long story short, you basically take that move, which is like this, and I'm kind of half doing it here just for for simplicity, but you kind of do this and then you duplicate that from the breakout, and like the end of that arrow, which is like up here somewhere, would be the objective. Since I'm using a log scale chart, I'm basically assuming a parallel move in percentage terms, which I think is a good representation of what Edwards and McGee were really getting at when they were doing their writing in the mid 20th century. The technology's improved and gotten better, and I think that matches the methodology they were talking about as best as you can. Good questions, and some other good questions that I didn't get to, but I will put them in the mailbag and hope to answer them at the end of this week. Thanks so much for watching today. I appreciate it. We'll be with you here as we track these market movements. I'll keep you updated with the Keller family vacay plans here in August, but I will definitely most likely be planning some time off. I'll keep you updated. We'll be keeping my Market Misbehavior Premium members top of mind as always. But in the meantime, I appreciate you joining me here today. For Market Misbehavior, I'm Dave Keller, reminding you it's always a good time to own good charts. Have a good night, folks.